In the ever-shifting landscape of modern markets, the term delta moving with raises despite uncertainty has taken on significant importance, particularly among traders, analysts, and financial content creators on platforms like YouTube. At first glance, this phrase may seem like a technical jumble, but it carries layers of meaning related to price sensitivity, market volatility, and the human psychology driving investor behavior. For YouTube audiences eager to understand the mechanics behind seemingly paradoxical market movements where prices rise despite looming economic uncertainty, grasping the concept of delta becomes essential. Delta, in the realm of options trading, refers to the rate of change in an option's price relative to the movement in the underlying asset. If an option has a delta of 0.5, for instance, it means that for every $1 increase in the asset's price, the option's price increases by 50 cents. This metric not only serves as a predictor of option value movements but also as a key insight into the trader's expectation of future performance. What makes delta so critical is its dynamic nature. Its value changes with every movement in the market, influenced by time, volatility, and investor sentiment. When markets are clouded by uncertainty, whether due to geopolitical tensions, inflation data, central bank policy shifts, or earnings surprises, one would naturally expect a pullback in asset prices. Investors traditionally flee to safety in such times, favoring bonds, gold, or cash. But what often puzzles both newcomers and seasoned investors alike is when the market defies this logic and continues to rise. Here is where delta and its movement become both fascinating and instructive. One of the reasons prices may rise amid uncertainty is due to strategic positioning by institutional investors who utilize options to hedge their portfolios. As volatility increases, so too does demand for protective puts or speculative calls. This, in turn, causes shifts in delta positioning across the board. Market makers, who must stay delta neutral to manage risk, are forced to buy or sell the underlying asset to maintain their exposure. This hedging process can actually push the price of the underlying asset upward, ironically, due to the very uncertainty that would otherwise scare investors away. YouTube creators who focus on financial education or market analysis often explore these mechanics to help viewers understand what's really going on behind the charts. A video discussing why the S&P 500 or tech stocks continue to climb, even as headlines scream of economic slowdowns, could break down how gamma scalping and delta hedging create self-reinforcing price movements. These mechanics are not always visible to the average retail investor but have profound effects on short-term price action. Another dimension of this phenomenon is sentiment-driven buying. In an age where retail trading is amplified through platforms like Reddit, Twitter, and Discord, momentum and narrative can override fundamentals. If a popular influencer or fund manager projects confidence in a sector, retail investors may rush in, creating a temporary delta imbalance that pushes prices higher. This surge, especially when combined with low float or high short interest stocks, can result in exaggerated price increases fueled by options volume rather than fundamental growth. Raises in price levels despite uncertainty are not always irrational. Sometimes, they are rooted in anticipatory behavior. Markets are forward-looking mechanisms, and investors often price in future optimism, not present gloom. If traders believe the Federal Reserve is nearing the end of a rate hiking cycle, or that inflation has peaked, they may begin accumulating assets in anticipation of a rebound, even if current conditions remain unstable. This forward pricing, reflected in delta changes across options chains, creates a situation where prices rise in the face of seemingly bearish conditions. From a YouTube creator's perspective, breaking down these complex dynamics in a clear and engaging manner is both a challenge and an opportunity. The use of visuals like charts showing delta curves, volatility spikes, or open interest MOPS can help audiences visualize the mechanics behind the moves. Explaining how a sharp increase in call buying leads to rising deltas, which then triggers market makers to buy underlying assets, creating a feedback loop, adds depth to what otherwise seems like irrational exuberance. Importantly, discussing delta movements in uncertain times also invites broader conversations about risk management. For individual investors or newer traders, understanding that markets can rise for reasons unrelated to macro stability is crucial. It teaches viewers not to blindly follow price action, but to analyze the underlying forces driving it. This includes examining options flow, institutional positioning, and sentiment indicators and not just earnings reports or economic data. Ultimately, the intersection of delta movement and market raises despite uncertainty underscores the complexity of modern finance. It reveals how deeply interconnected technical mechanics, investor psychology, and institutional strategy have become. For those consuming YouTube content in this space, it's an invitation to go beyond surface-level analysis and delve into the structural forces shaping price action. Whether you're an aspiring trader, a curious investor, or a content creator looking to explain the markets in fresh, insightful ways, understanding delta movement is a critical piece of the puzzle. Would you like a thumbnail idea or script to go along with this article?